Hi, this is John Vance, president of Vance Wealth, and I'm here today to share a tax strategy that we help many of our clients with, and it's known as tax loss harvesting. So one of the things that, looking at the last, let's say 12 months we've been living through during COVID, when COVID started and the stock market had a tremendous amount of volatility, we saw losses in the stock markets of over 35%. And it was a really tough period of volatility. It was extremely sharp, pretty violent on the downturn. And the reason why I'm sharing that with you is that going through an example like that of a really volatile market allows us to take advantage of something called tax loss harvesting, where we go in and take some losses in client accounts. And the benefit of taking those losses is that we can use them as a tax asset or a tax write-off in the future. So what I'm going to go through today is go through an example of how this works in practice and try to visually lay out what a good tax loss strategy looks like. So the example I'm going to go through is a hypothetical investment, $5 million portfolio with 60% in growth investments and 40% in fixed, which would make about $3 million in long-term focused or stock-related investments and about $2 million in fixed accounts, combination of bonds and cash. And the reason for that is the client needed about $200,000 of annual withdrawals. So what we're going to focus now is just simply on the stock part of this, not the bond part of it. So what we're looking at is this really what I would call a buy and hold strategy. So in looking at just your stock portion or your equity portion, if you take a buy and hold approach, you can look on the left-hand side, we have this $3 million bucket of money. That's the initial investment. We then experience a 20% decline. So what does that mean? Well, that means that your $3 million is now worth $2.6 million, and you have a loss on paper, an unrealized loss of $600,000. So that unrealized loss is obviously painful, and without any action, meaning just taking a buy and hold strategy, then you're going to be in a position where when the markets then recover and have a 10% growth from your initial investment, your account is going to be worth $3.3 million, which is obviously why you invest, and now you have an unrealized gain of $300,000. So with the buy and hold strategy, just kind of going through and allowing the account to go down then up, basically no real tax issues when it comes to this. But let's just say you need some money at year end. So you come in and say, you know what, I want to sell $200,000 from this, and based on that $200,000, you would probably realize about $20,000 in capital gains, which would cost you, let's say, around $6,000 in tax. So that's really the buy and hold strategy, kind of a simple view of it. What I'm now going to look at is what about looking at investment management with tax planning. So we're going to take the same profile here. Is you start with $3 million in your stock account and your growth account, it loses 20%. So you now immediately have an unrealized loss of $600,000. Well, what we do is we go in and trade the accounts and do what's called loss harvesting. So we go in and actually take some of those losses, reinvest the money in similar but not identical investments, so that when things do recover, that you're in a really good position. And so you can see now this chart has changed a little bit, and we're looking at now, because you realize these losses, which are represented in the green color, we now have a $600,000 realized loss. And that loss can be used in the future against a long-term gain. So now the markets did the same thing as in scenario one with the buy and hold strategy. Your account value is back to that $3 million. And so now what you have, and let's just pretend that this is a year, you have on the books a $600,000 realized loss, and you have a $900,000 unrealized gains. And remember, unrealized means not taxable yet. So same client needs $200,000 from the portfolio, so they go ahead and realize the $200,000, which actually realizes about $55,000 in capital gains. But you don't have a tax liability because that $55,000 of gains is offset by the loss that was created. In addition to that, the rules state that if you have a loss on your tax return, you're able to use $3,000 against ordinary income as a deduction. So in this simple example, just by being proactive with money management, we were able to save the client in this simple example about $7,000 in one tax year. And on a go-forward basis, we have this loss carry forward of roughly $545,000 that can be used in the future, which can be really tax advantageous. So I hope that little lesson on tax loss harvesting was helpful. This is a key tenet of what we do here at Vance Wealth. If you're interested in a 30-minute just consultation around what you're doing from a financial planning perspective, a tax planning perspective, maybe even looking at reallocating your accounts,